welcome to this Baillie Gifford live webinar where we're going to delve into the Monks Investment Trust. I'm Katrin Schindler of Citywire, and with me here today is Spencer Adair, the manager of Monks. Over the next 45 minutes, we'll be discussing the ins and outs of the trust, its core philosophy, and how it fits into the bigger picture. And the way this works is I'll be picking Spencer's brain with my questions for about 30 minutes, and then it's time for your questions. So if you have any, please submit them at any time via the chat box, and I'll put them to Spencer in the last 10 minutes of the session. And on that note, let's dive right in. Spencer, welcome and great to have you.
Thank you so much for having me. It's good to be here.
Spencer, I guess it's fair to say that Monks has come a long way. I mean, based from its small origins more than, I think, 90 years ago. It's grown to more than £2 billion today. So how do you see Monks being used within investors' portfolios today? Or if we could put it differently, what is Monks all about?
Okay, you're right. So Monks started in 1929. And for the historians out there, you'll know that was almost right at the market peak. So it had a difficult first few years leading into the Great Depression and then into the war. So the first managers had a tough old time. Today, Monks' objective remains long-term capital growth. So please do not own Monks if you need income or if you have short-term needs. Monks is about building wealth over the long term. And we think the best way to build that wealth is to be a part owner in structurally growing businesses and not to pay too much in fees. So that's what we do. We invest in equities in companies from every corner of the world, from the largest corporate giants to emerging minnows, and even a small selection of private companies, all while keeping an eye on lowering costs. The wealth creation is achieved by the hard work and compounding of our underlying equity holdings. These are structurally superior, expanding businesses with good revenue, cash flow, and earnings growth rates. And once long-term compounding is in train, we do as little as we can to interrupt it. So we've got a very broad set of geographies we can invest in, industries and sizes, but also we diversify across the nature of growth. Now, I've talked in previous webinars about our different growth styles, so I'll be very, very brief here, but we balance the portfolio across our growth stalwarts, which are get-rich-slowly, high-quality compounding machines, such as Estee Lauder in cosmetics or Pernod Ricard in spirits. These are proven business models with really deep moats, and our edge is patience. Next up would be rapidly growing innovators, much younger than the stalwarts, often creating their own market through disruption, such as Tesla in electric cars. And it's really imagination about what they might become and our ability to tolerate very sharp swings in sentiment are our edges. And then finally, third up are our cyclical growers. They are going to be exposed to some long-term structural trends like the need for lithium in batteries. Progress will not be smooth year over year, but will have a very material uplift over a span of several years. So that's all packaged up into low-cost, one-stop shop for getting a broad mix of growth equities from right across the world.
Great stuff. Now, let's take a closer look at performance, which has been challenging in recent months. Why has that been the case for Monks, would you say?
Yeah. So our NAV is down just under 19% over the last 12 months. I think challenging is being polite. I would say that's very disappointing, and it's far short of the benchmark. The context would be that NAV grew by 55% in the previous 12 months. So if we take a step back, we've had 2 years of extreme ups and then extreme downs. So growth investing had a strong tailwind, and that's turned right around and become a strong headwind. So the results in the last 12 months are really, in that down period, are a reflection of decisions we took in the more buoyant times. So we reacted to the kind of extreme 55% growth in 4 ways. First, we issued shares when we were trading above fair value. And then in absolute pounds and pence, we've been the most aggressive trust in the UK buying back stock when we're trading at a discount during 2022. Secondly, we let gearing fall. Gearing was 8% and we let it fall all the way back towards 1 during the good times. So we didn't chase that performance up. I took the foot off the accelerator. And then as NAV has fallen this year, we've been letting gearing rise gently. The mistake was, though, that we were too slow in selling down our largest winners. I clearly should have been much more aggressive in rebalancing between the different growth types. So although we were net selling our rapid growers boomed so quickly that the weight in the portfolio rose to above 50%. What went up quickly came down even quicker. It was our riskiest, most speculative positions which moved fastest. Now, with hindsight, I clearly should have been more interventionist. I should have risked interrupting the compounding, given the extreme nature of some of the share price moves. So during the last 6 months, our strongest performers have come from stalwarts and cyclical growth stocks, while the weakest performers have been rapid. And just to be crystal clear, although we were net sellers of rapid growth companies, we did also buy a few small new holdings in the last 12 months that proved to be very poorly timed. So there were some individual stock errors. If I try to put some numbers on these things, if I'd been more aggressive in rebalancing, we would have performed about 4 to 5 percentage points better. And if I made any mistakes on new purchases, we would have been 1 or 2 percentage points better. So NAV would still be down in the maybe double-digit low teens range. So the headwind against growth investing has been very strong. And then the final thing, I said there before, the final thing that we did when times were good was we locked in about £100 million of very low cost, 1.8% fixed debt. And that's fixed until the middle of the century. And that gives us great long-term inflation protection. So hopefully that helps you understand what's happened, some mistakes we made, and what actions we've taken.
Lessons we'll learn, in other words, I guess.
Yeah, exactly. Lessons learned.
You just mentioned that there was a strong headwind for growth investing. So one might wonder if the best years for growth investors might already be behind us. So Spencer, not to put you on the spot or anything, but is that it for growth investing, or where will growth be coming from in the next decade?
Well, I can probably answer that question in a couple of different ways, but I can, as we stand today, post the sharp falls, I'm like a child in a sweetie shop. Every corner of the portfolio is offering structural growth companies at deeply discounted valuations. Now, the painful bit, of course, has been the valuations have become discounted, but from this point, it's very exciting. The market's only valuing what's directly in front of it. Any company with structural growth ambitions or prospects are being marked down. In the past, we used to say a bird in the hand is worth 2 in the bush. But today, it's more like a bird in the hand is worth 5 or 6 in the bush. The market's giving up any future growth in terms of for near-term certainty. And this feels like, to me, late 2008, just post the GFC. Now, at that stage, we repurchased Amazon around the time the market was punishing it for having growth ambitions and investing in a loss-making division called Amazon Web Services. Today, that business has profit margins over 35%. We've produced approximately a 60-fold return on Amazon investment from that bottom point. But yet it fell another 40 percentage points just after we bought it. And in fact, it's fallen sharply between 20 and 40%, 13 times in the last 14 years of our ownership. So it's really hard to avoid volatility. At the top and at the bottom, people always get carried away. I do not think growth investing's time is at all over. And I think rather than avoiding volatility, you've got a much better chance of building an edge by reacting well to it. And you have a delicate balance of just blunt honesty about what went wrong, not dwelling too much on it, and then remaining optimistic and reward seeking.
Just staying with the topic a bit longer, how hard would you say is it to be a growth investor these days in this environment that we're currently in?
Hard, I'm not sure hard is the right, it's an honor to be an investor, look after other people's money. I certainly haven't had as tough a test as the first managers and monks had a century ago. The ideas that we're finding and the returns on offer are really exciting. If you don't have to worry about trying to time the exact bottom of this particular slump, but rather look out 5 and 10 years. So if you stretch your time horizon, it's really not hard at all. Also, I think you learn an awful lot about your company management teams and their character during difficult periods. So it's very easy to say, a company finds it very easy to say they're long-term when things are going well. But it's during a difficult period, you get a clearer degree of signal rather than noise. You get signal rather than spin. And plus, we're we're getting to buy some great companies that we've admired for years, but we were held back for valuation concerns. And now the absolute valuations are low enough that we can pick them up. So we've got a clear head. We're on the front foot. We're finding lots to add to and new things to buy. One really brief example is Adobe, which is a software company, and it helps create digital creative kind of content. And as we move to richer graphics, more digital documents, more screens, if we have more creatives working in the industry, we would expect revenues to compound 10 to 15% for many years to come. Now, Adobe is extremely high quality. It's debt-free. It makes 90% gross margins, high returns on capital. It's buying back its own stock. And when we first looked at Adobe, it was on a pretty rich valuation, 30 times forward free cash flow. We've delayed purchasing it for a number of years. It's now back to 20 times free cash flow. So we use the sell-off in order to pick up those kind of growth assets on a really long coveted company. So the opportunity set expands because valuations have fallen.
I'd like to change tack a bit and focus on your approach. You state that you're drawn to businesses that are addressing a crisis in a novel manner. So what exactly do you mean by that? And if you could give some examples as well.
Yeah, okay. So one of the first questions we ask any company is, what is the purpose of this company? What's it trying to achieve? And that's a really deceptively simple question. What is the purpose of the company? But it's very insightful. And we're looking for, can the management team understand what's it trying to solve for its customers? Does it address a pain point or a crisis? And the reason for that question is that sustainable growth and profits only come when companies' customers think they're paying a fair fee for a good service. And I know it appears very basic and obvious, but over time, companies drift and they forget what they're really for, and they become either inwardly looking and therefore prone to disruption, or they start to exploit their customers and build up the hidden negative, the hidden debt of customer dissatisfaction. So if the CEO can't explain what they're really doing for customers and why they're different to others, then we want to start the process of looking at that company for months. So one example would be, I think our most recent purchase for the trust would be Royalty Pharma, which is a US listed company. And this is a company which funds innovation, biotech innovation, by buying up royalties on some of the largest blockbuster drugs in the world. The customer crisis is that royalty is a direct funder, royalty is a direct beneficiary of stock market turmoil, and it funds innovation. So in the last 5 years, you've had 260 biotech firms floated in the market. That group are going to find it really hard to raise enough capital to complete their clinical trials. So they've got enough money for maybe the first couple of phases of work, but they haven't got enough money for that last big phase 3 study. But royalty funding only accounts for 2% of the market today. Equity funding's been a lot of the rest of it. And this company can step in and provide late-stage funding in exchange for a cut of future revenues. And so this is a company which is well diversified across 35 drugs from the likes of Johnson & Johnson, Novartis, and Merck. The long-term royalties have a 13-year average life, so it's got long duration cash flows. And it starts with 90% gross margins, 80% net margins. So I think that's the world's most profitable drugs company, legal or illegal drugs company. It's incredibly profitable. And yet growth, and it's inflecting because the crisis for their customers is getting larger, and therefore its license to operate and grow is getting wider. And we're picking that business up on a long-term PE of just under 12 times earnings, which feels really capable of double-digit growth for a long period of time.
Great stuff. Can we focus on one aspect of your approach, which is the long-term outlook that you have for your holdings? How do you convince investors that you're actually in it for the long run? Or put differently, how do you prove that your holdings are set for the long term?
So if I answer the higher holding set for the long term part of the question first, so first we try to assess the motivations of the management team. 2/3 of our holdings have a founder or a family still in place. Royalty Pharma, still run by its founder, for example. These companies tend to be longer term. They are maximizing for handing the business on to the next generation rather than just meeting short-term profit goals. Mm-hmm. Generally, they tend to treat their customers and staff better. They don't cut back as aggressively in downturns like today, and therefore they take market share when the good times ultimately return. They tend to be quite wary of too much debt. So Monk's Holdings in aggregate have got a debt to equity ratio of just 12% versus an average of 53% for peer companies. So you can also look at how the companies are allocating capital. How much are they trying to grow? How much are they spending on the future, such as R&D, marketing, industrial capex, versus how much they're spending on today's shareholders, such as dividend and buybacks? It's probably been a little while since I've run these numbers, but Monk's companies on average spend 2.5 times more on R&D and capex compared to the average company. So our companies are all trying to grow and invest in tomorrow. They won't all succeed, it won't all work, but I'd rather back the ambition that they're in it for the long term. So in short, in terms of a company perspective, it's about understanding the motivation, the alignment, auditing their actions, looking for conservative balance sheets, and then auditing their ambition. The other part of your question was how do you convince shareholders that we're in it for the long run? Monk's has been run by Baillie Gifford since 1931. That's a board decision. So we've got many decades of heritage that here. The team running Monk's also runs one of Baillie Gifford's largest institutional approaches. So we sit right at the very heart of the firm. We're backed by a lot of institutional strength resource. And then from a very personal perspective, 100% of my pension is in Monk's. I own 2 shares in total, Monk's and the Shareholders fund, and I've been buying more Monk's throughout 2022. So from an organizational and personal perspective, we're definitely in it for the long term.
Great, living and breathing Monk's, it seems. Great stuff. Now, when you're backing companies for such a long time, you get a front row seat to the changes that are happening. What were some of the most noticeable changes you've witnessed over the time?
Yeah. I think that the biggest change has been the last 20 years. The disruption has primarily been in media and advertising, in areas which are relatively, in entertainment, areas which are relatively narrow. And if I think about what we're now seeing, the disruption that's coming is in much broader areas. It's in food, it's in insurance, in finance, in law and order, in education. And those areas are much more important to society. They're generally much larger. And so if we thought that the likes of Google and Amazon and Facebook built hundreds of billions, if not trillion-dollar businesses, I think what's going to come next is even more ambitious. And that's the level of wanting to impact society, and that's even before we talk about trying to solve climate change with various bits of technology. The problems they're tackling, that consumer crisis element, is a much larger one than just getting a more targeted advertisement to you. So that's really quite an exciting step up in the ambition of the difficulty of the problems that are trying to be tackled.
Mm-hmm. And just out of curiosity, when you hold companies for such a long time, how do you stop yourself from actually, falling in love with them, kind of, from getting too attached in a way?
Yeah, no, that is a risk, and we have to watch out for that. We build some challenge into our network. Mm-hmm. So some of you know we can't possibly run Monk's just as a 1 or 2 person show. So we have a network of scouts around the firm that help us. Every month we ask those scouts, what are the 5 things that you'd sell tomorrow if you're running Monk's? What is the 5 mistakes Spencer's making? And we really value hearing dissenting views, especially what we may have missed. Mm-hmm. I can't stand cheerleaders and people who only say yes. So our network is full of people who will speak their minds. Okay. Secondly, because we invest in this broader suite of growth companies, we are meeting everybody. So we recently did some work on General Motors and BP, in part as potential investments. Now they have been bought. This is just work we've been doing. But also, as well as assessing their individual merits, it was also to partly understand their ambitions in areas such as electric vehicles and in green energy, respectively. Now, as a result of that work, I actually reduced Tesla a little bit, understanding how serious General Motors were getting into electric vehicles, how quickly they were ramping up. But I also bought an electric a cable maker for the electric grid, because that was one of the bottlenecks that BP had highlighted in terms of what was needed to really accelerate our move towards green energy transition. So I mean, that's another area that you can stop yourself falling in love with companies by just meeting a lot of them. We do think in scenarios for each of our companies. We deliberately think about what might go right, but also what might go wrong. And then we give the probabilities to those various scenarios. So by being explicit about what might go wrong, it does help you stop falling in love. And then finally, we tend to move quite slowly. We tend to move our holding sizes quite slowly. So if we're very new to a company, we will take a 0.5% holding, and then we'll sit back and observe their character and their actions. And then only if we like what we see, we may add more 12 or 24 months later. So we don't, we don't kiss on the first date. We're relatively slow in terms of our due diligence and our holding sizes.
Great stuff. Thank you, Spencer. Now let's get some numbers in there as well. What was the turnover in the last decade, and how does that number compare to the marketplace?
So the average turnover has been about 15% a year. That implies a 5 to 10 year average holding period. I'm not sure who you'd compare in your marketplace, but Monks has got some of the lowest turnover. It's got lower turnover than most. My thinking here has actually evolved a little bit. I'd previously been kind of pretty steady year-over-year turnover. It was pretty steady. I actually think that during periods of extreme market exuberance or pessimism, turnover should naturally be higher because the opportunity set is higher. So if I have any regrets over the last 12 months, I think turnover was 11% in the last 12 months. It probably should have been closer to 20. Just we should have taking those profits and things which have been doing well.
Okay. And Spencer, we can't have a conversation like this these days without mentioning sustainability in any shape or form. So the question is, how do you incorporate ESG principles into your investment process, into your investment approach?
Yeah. So ESG is embedded right into our process. It's right into the research that's carried out by the fund managers and analysts. We are helped by a core member of our team being dedicated looking at sustainability, and he's got years of experience in this area. We publish an annual Monks sustainability report, and we've done that for several years. That highlights real-world examples of engagement, influence, voting. We actually do help shape the companies that we invest in. So I'm on the board nomination committee of one of our companies. We're helping pick the board members that are looking after the company. And just to be crystal clear, Monks is a profit-seeking trust. So we're not greenwashing any of this stuff. But if your approach is a long-term compounding of wealth, then small s sustainability and assessing alignment are naturally central to the investment process. So we're not setting Monks out. Monks has always cared about sustainability of profits because we're a long-term compounding trust, and that's where our ESG credentials come from.
Fantastic. And now, before we move on to our audience questions, Spencer, give me the elevator pitch. So in a nutshell, what makes Monks attractive to investors?
Okay, well, it's a large liquid trust. It's proven durable over decades. It's helped, of course, by the three types of growth behaving differently. It's focused on long-term wealth creation. We've got low fees, and we've set it up structurally that fees should fall further as the trust grows. And we've got an aligned, proven team with a great long-term track record. This is not our first rodeo. This is not our first sell-off. I remember the 2000 tech bust. I remember the GFC. And then finally, we've got a counter-cyclical application of gearing and buybacks. And the sell-off in growth assets has really been quite extreme. I'm not saying we're definitely at the bottom, but we are very clear-headed, and we're deploying capital into high-quality growth ideas on pretty modest absolute valuations.
Fantastic. Now it's time to take a look at some of the questions from our audience. And as it happens, we have quite a lot of them. So the first one refers to performance. We've already touched on the topic earlier, but this question is looking at it from a different angle. And it says, given the trust's fairly dire performance in the past 6 months, what's the strategy to recover? And then this also ties in quite nicely with another question, which says, how do you manage underperformance of certain holdings? You've already touched on that as well, Spencer. But so 2 questions here: strategy to recover and underperformance of certain holdings. How do you manage it?
Well, the strategy to recover is to be clear-headed. We're applying increased gearing as the assets have sold off. We are going through and assessing every single company in terms of how they are progressing fundamentally. If a company's not making fundamental progress in terms of its operations, it will be sold. If it's continuing to perform operationally well, but the share price is weaker, then that gives us an opportunity to add. So it's really bottom-up, case by case. The portfolio is well balanced between the 3 growth types, and we're, in absolute terms, we feel pretty excited from where we are at the moment. And then the second part of the question was, just repeat the second part of the question.
Sure. How do you manage underperformance of certain holdings?
Yeah, well, that comes back to, for every stock, we have a forward-looking hypothesis, and we assess the company's actions, the management team decisions, how they're allocating capital, how the results are coming in, and if they are performing in line with our expectations, we tend to leave it alone, and if they're performing below expectations, we engage. And if we don't get good answers in terms of how quickly they will get back on track, we sell. So we have got 5,000 or 6,000 different companies we can own. We only own 120. So if something's not performing in line with what we hope, we don't see significant upside, then we move on.
Mm-hmm. And based on that is another nice question. It ties in quite nicely with that, or follows up from that. It says, do you adjust your holding categories depending on the market cycle? For example, when rapid growth was top in October, would you redeploy capital in stalwarts or a latent growth category?
Yeah, so we allocate to the 3 categories on a bottom-up basis, and it's driven by where do we see the highest risk-adjusted returns. So, for example, if I'm looking at Adobe or Royalty Pharma, it's how does that stack up on a risk-adjusted basis compared to everything else in the portfolio? So, one of those is a stalwart, one of those is a capital cycle company, and that's absolutely fine. So we're driven by the idea flow. In retrospect, looking back, we absolutely should have taken 5 or 10% out of rapid growers and reallocated across the businesses we had in stalwarts and cyclical growers. That would have dampened down the underperformance in the last 6 months.
Mm-hmm. We also have a few stock-specific questions. One of them is about Peloton. I mean, the company has had a rough few months, to say the least, both in terms of media coverage and share price performance. But why did you hold on to Peloton nonetheless? And did your governance team challenge you on the holding?
Yep. Okay. So Peloton was a relatively new buy. I think it was September last year. So it's been in the portfolio for less than 12 months. It's one of the handful of mistakes I mentioned in terms of the new purchases. We bought a 0.5% holding. I feel pretty silly about it in retrospect. Peloton's a home exercise company, the largest interactive fitness platform in the world. It's got 2 businesses. It's got a hardware business such as bikes and running machines, and that's where all the trouble has been. Demand was a bit inflated during lockdown. They really struggled to cope. They got their manufacturing in a real mess. They lost the operational grip on the business. Mm-hmm. We have been, in terms of the governance team, we have been engaging with the company at the very highest level, including the board and independent directors and chairman. We supported the new CEO, who we know. He was a former CFO at Netflix and Spotify, 2 of our other holdings. He has also brought in a new head of supply chain to sort out the mess. They've only been there 6 and 8 weeks respectively, so it's still pretty early stages. So yes, the governance team have helped to challenge. We've been challenging the company. I said it 2 businesses. The problem's always been on the physical bike manufacturing has been the problem. The reason why we bought it was really the other business, which is a media business. It's the exercise classes, and that's a really very good business. It was the bedrock of our investment case. Revenues are about $1.3 billion, so it's a pretty large business. It's got gross profit margins of 2/3. And they're trending higher. It's got very high membership retention, exceptional engagement. The users tend to be quite rich and therefore maybe less economically sensitive during any downturn. So whenever I look at Peloton's market cap of 4.4 billion, that is more than justified by the exercise media business that they have. That assumes the hardware business is worth zero. And one of the mistakes we made is it could be worth less than zero. We just have to, they need to get a real operational grip on that. So we've been engaging. We're going to assess the plans as they come out. And if they're not up to our scratch, if they're not up to scratch, not up to our expectations, I'll be very happy to sell it if it hasn't got a clear plan to get back to good levels of profitability in a pretty short period of time.
Yeah. Now, another stock-specific question is about Oatly, and it comes with a little explanation from the person who asked it. I'm just going to read it out as well because it adds a bit of color. So the question is, why is Oatly in your portfolio? The CEO is a bit of a self-publicist. In brackets, he's all over the cartons. The product has no actual moat. All it is oats, salt, and water. At a push, you could classify it as the fever tree of the milk world, but it's expensive and doesn't have a lot of competition. I do have to say I like the phrase fever tree of the milk world, but that's beside the point here. So Spencer, why Oatly?
Okay, so let me try to hit, so there were several different points in that question. Let me try to hit them, and if I haven't, pull me up and I'll make sure I answer them all directly. So why do we own Oatly? We see a very long runway for growth. There's a big move towards non-dairy milks, and that's pretty entrenched, and it's going global. It started in Northern Europe and Scandinavia, Germany, and it's now increasing in the UK and elsewhere. And that's partly driven by health reasons, partly environmental, and then partly on the general rise of veganism. All of those seem fairly entrenched. Milk is actually the number one volume item at retail globally. And plant-based milks have been gaining market share from pretty low base. So it's a long runway to growth. Within plant milks, oat milk is gaining market share from others such as soya or nut milk. So it's got that growth within growth. And then finally, it's got a longer term, they're planning to move into things like yogurts and ice cream and other dairy products. So there's product category expansion to come. I'd like in terms of the actual definition of could they have an advantage, the shareholder was asking about the formulation, oats, water and salt. I probably wouldn't define Oatly's formulation or Oatly's edge as their formulation. Coca-Cola, which hasn't been a bad long-term investment, you could dismiss that as just water, sugar, and caramel. So it's not. So I wouldn't go for the nature of the product itself. Coke's edge over time has been availability and brand. That's really what Oatly are trying to address. So the self-publicist CEO, who's on the packaging, he's perfect for the company at this early stage of its growth opportunity, and as they're building brand awareness. Now, what's encouraging is that he has been recruiting some serious talent, 30-year veterans from the likes of Mars, from Danone, from Unilever. So he's surrounding himself with people that really know the operations and inside out, and that's perfect. If the shareholder really wants to get into it, Oatly does have a production edge. It's been doing this for a quarter of a century. It uses enzymes to liquefy the oat kernels rather than using oat flour, which other oat milk does. In theory, that's better for your health. It gives a different taste, a bit different texture. So there is something in the formulation. I won't say too much because we're getting dangerously close to kind of trade secrets here, but they do something quite different with their oats than some of the competitors. Then in terms of profitability and how do we make money, demand has outstripped their ability to supply product. So annual average growth at Oatly over the last 4 to 5 years has been 70% a year. So they've had to subcontract and out-license production. So they had a choice. They could have stayed quite small but they decided availability and brand are the two advantages. We're going to maximize for availability, and so we're going to subcontract out their production. And they're now building capacity in-house in order to take that subcontracted volume back in-house. That means that gross margins should climb from a very depressed level at the moment because you're giving away lots of profits to your joint venture partners who make it. And so gross margin should climb from 10% today up to 40 pretty quickly, and operating margins going from losses up to maybe 20%. So in terms of the next 5 years, you've got a very rapid top line structural growth. You've got even faster profit growth, which is more or less underwritten because of this shift towards more in-house production. And our central case would be this is on 7 times earnings in about 5 years' time. You can pick your example. Should this be like Danone? Should it be like Nestle? Should it be like Fever Tree? Should it be like Monster Beverage? All of those companies have got PEs many times higher than what we think Oakley would have in 5 years' time. So that's how we should make quite a lot of money if we're right. There's 3 outstanding questions. Firstly, can anyone actually build a sustainable brand in dairy alternatives? We just don't know yet. The category's still quite young. It's still quite limited to North European and US markets. So will it really go global? It has to, can it crack China, India, etc.? We just don't have the evidence yet. And thirdly, the taking all the production in-house and tripling in-house production capacity is going to require some capital. So at some point there could be a rights issue here that we have to underwrite in order to actually get the factories built.
Mm-hmm. Great. Now, stepping away from stock-specific examples and looking at the broader portfolio, this person is wondering if, with about 110, there are too many listed companies in the Monks portfolio. And the question is, if there had been between 70 to 80 listed companies with high amounts invested in them, could you have a more compact portfolio with more benefits, for example, when it comes to transaction costs?
Okay. So transaction costs are pretty low because our turnover is quite low. So whenever we look at the impact on the expense ratio of the total fund, transaction element is tiny. So I'm always for maximizing costs and minimizing costs and maximizing savings, but it's not the absolute size of holdings within Monks that makes a difference. And just to give you a tiny bit of detail on costs, whenever we started running Monks as a team in 2015, the total expense ratio was in the high 50s, and today it's in the low 40s. So we've really, the strategy is, as Monks grows, we want to share the economies of scale with shareholders. And my ambition is to get the total expense ratio down into the 30s. That may not happen if the NAV is falling and if shares are under pressure, but under more normal conditions, the way we set things up is we would hope that the total expense ratio starts with a 3. So we're continuing to we're continuing to look for savings there. More broadly, over time, I think there is a case that the number of holdings should maybe fall from 120 to about 100, say. So there will be a gradual concentration, but that will happen naturally as investment cases expire, mature, get to the end of their life. We will sell individual holdings, then reinvest into some existing holdings. So there will be a gentle concentration, but it's going to be modest and it's going to be over, say, a 5-year period.
Okay. Let's finish with a forward-looking question to wrap it up. This person says, I have subscribed to several of the webinars, including Scottish Mortgage and US Growth Trust, which is great. We like that. In each case, some reassurance has been given for the future despite significant falls, with trust valuations now reducing back to the levels of 2019. Whilst there has been a move out of growth companies, how do you see the situation developing for the investments of Monks? You've already talked about that in bits and bobs throughout the questions, but if you just want to sum it all up.
So if I sum it up, the premium that we're paying for our companies, so our companies have got balance sheets which are 5 times stronger on average. Their structural growth rates historically have been twice the rate of the market. Their inside ownership is 2/3. It is very, very high. So we think we've got a strongly aligned, conservatively financed, structurally growing companies. And today, if I look at the valuation premium that Monks trades on, the holdings in Monks trade on relative to the global market, it's trading at about a 20% premium. That's as low as I remember. So the the benefits our companies have will come out in the long run, but the valuations we're being asked to pay today is really extremely modest. I can't promise in the short term valuations won't go lower, but on any sensible time period, that strikes us as great value. That's why we're buying back shares, partly because the discount's wide, but also partly because we think the absolute valuation is too low.
Okay, Spencer, I'm afraid that's all we have time for today. That was delightful. Thanks so much. And thank you all for watching, and see you next time.